Okay, let's unpack this. Innodata Inc. Ticker symbol INOD. I mean, the stock movement has been, well, jaw-dropping.
Absolutely. You look at that 52-week range.
Exactly. From like $5.50 all the way up to $71. And recently it's sort of settled around, what, 37, 38 bucks?
Yeah, after bouncing around a bit, even just recently, what drives that kind of volatility? That's the big question.
It really is. And that's what we're diving headfirst into today. We've got this detailed INOGO Stock Deep research report dated today, April 29th, 2025, plus a whole stack of other data.
So the goal is to cut through the noise, right?
Precisely. Filter it all down and give you, the listener, the key insights. Think of it as your shortcut to understanding what's going on with Innodata without drowning in information.
And it's interesting because Innodata sits right at the intersection of, well, big data and AI. Two massive dynamic fields.
So understand this one company actually tells you a lot about the bigger picture, the trends shaping tech right now.
Exactly. It's a window into that world.
So our mission for this deep dive, make sense of Innodata's stock roller coaster and figure out its place in this whole AI revolution. We'll look at their business, the management, the financials, market sentiment, who owns it, the risks.
And the data does seem to throw up some, let's say, conflicting signals.
Definitely some surprises in there. So yeah, let's try and piece it all together. Is this volatility just about, high growth, potential hitting uncertainty, or is there something more fundamental?
That's the core question we need to keep asking.
Okay, so for this first half, let's build that foundation. We need to really get what Innodata does, how its management stacks up, and what their financials actually look like right now.
Makes sense. Let's start with the business itself. What's their core identity?
Right. So fundamentally, Innodata is a global data engineering company. Their big focus, AI. They've actually been around since 1988.
Wow, 1988. That's a long time in tech. Gives them some serious history.
It does. Their mission is basically helping companies use data for AI innovation and just running things better. They have three main business segments.
Okay.
First is Digital Data Solutions, DDS. This is the big one, the main revenue driver. It's all about prepping data for AI, collecting it, creating it, annotating it, images, video, text, LiDAR, code, all sorts.
So the real engine room for AI models.
Exactly. They also help deploy and integrate AI models, plus do general data engineering support. And get this, DDS revenue jumped 129% year over year in fiscal 2024.
Whoa, 129%. That's explosive growth. But where's it coming from? Is it broad-based?
Good question. And here's the kicker. One single major tech client made up about 48% of their total revenue in FY 2024.
48% from one customer.
That's a significant concentration risk right there.
It's massive risk. It's great validation, sure, but incredibly risky if that client changes plans or cuts spending.
It's definitely a double-edged sword. Strong relationship, yes, but huge dependency, for sure. Their other two segments are smaller. There's Synodex, that's focused on insurance and healthcare. Uses AI to turn messy medical records into structured data. Revenue comes from SaaS and managed services.
Okay, so a more specialized vertical play there.
And then there's Agility. That's an AI-powered platform for PR and marketing folks. Think media databases, content distribution, monitoring, mostly subscription revenue.
So some diversification, but DDS is clearly the powerhouse driving that recent surge. And that powerhouse relies heavily on one client.
Yep, that's the story. Diving deeper into DDS, they really offer end-to-end services, not just labeling data, but the whole life cycle. And they use global subject matter experts, SMEs, to make sure the data quality is high.
Using SMEs, that's important. It suggests they're adding real domain knowledge, not just basic tagging. Could justify higher value, maybe higher prices?
Could be. For Synodex, it's about making sense of unstructured medical data for things like underwriting or clinical documentation. Agility gives PR teams the tools for outreach, monitoring, analytics.
These specific platforms show focus, and they probably generate more predictable recurring revenue than the project-based DDS work.
True. But the tech backbone for a lot of this seems to be their Golden Gate platform. They call it a low-code AI platform.
No code. Interesting.
Yeah, it ingests unstructured data, manages different AI models, including LLMs, pulls out intelligence, supposedly without clients needing a massive team of data scientists. They say it underpins a lot of their work.
That low-code angle could be a real differentiator. Makes powerful AI potentially more accessible to more businesses.
They also have a web-based annotation platform, a document intelligence platform. And they just launched a new generative AI test and evaluation platform using NVIDIA tech.
Ah, testing and evaluation for Gen AI. That's smart. As AI gets deployed more, safety, reliability, ethics, those have become huge concerns. That's moving up the value chain.
Seems like it. Operationally, they're global. Over 6,600 employees, 20-plus delivery centers, big presence in the U.S., India, Philippines, Sri Lanka.
That global footprint gives them access to talent and likely cost advantages in some regions.
And the client list, really impressive. By the end of 2023, they had 5 of the Magnificent 7 tech giants as LLM service customers.
5 of the Mag 7. Okay, that's serious validation of their technical skills.
But it circles right back to that concentration issue, doesn't it?
It absolutely does. Strong endorsement, but stark reminder of the dependency.
Their market cap is hovering around $1.2 billion right now.
Yeah.
So if we boil it down, what's their core value proposition?
It really looks like they're enabling AI deployment. They do the essential groundwork.
Right.
High-quality, scalable data annotation and engineering. That's critical for AI. They combine their long experience with tech like Golden Gate, plus those industry platforms and the focus on quality, scale, security.
Okay, so the key takeaway here for you, the listener, Innodata is a crucial enabler in the AI ecosystem, doing that foundational data work.
Right.
But there's this major tension, huge growth fueled by tech giants versus the massive risk of relying so heavily on them, something to keep firmly in mind.
Absolutely. Now let's zoom out a bit and look at the industry they operate in, the whole AI and data engineering space.
All right, and this market, the growth forecasts are just staggering.
They really are. It paints a picture of enormous potential, which Innodata is clearly trying to tap into.
We're talking the global AI market potentially hitting, what, $2.5 trillion by 2033? That's a compound annual growth rate, CAGR, of almost 34% starting now.
And AI engineering specifically growing even faster, maybe over 40% CAGR. Even niche areas like agentic AI for data work are projected for huge growth.
It shows this isn't just hype, right? It's a fundamental shift in how businesses are operating.
Definitely. And the data annotation market in Innodata's core DDS area is also set for big growth. The numbers vary a bit between reports.
Yeah, I saw forecasts ranging wildly, some up to $80 billion. But even the lower ones show massive expansion. The U.S. market alone might quadruple by 2030.
The exact number isn't as crucial as the universal theme: strong, sustained growth. The demand is clearly there.
And the drivers are pretty obvious. Advances in machine learning, demand for automation, the explosion of data, and the need for high-quality labeled data to train models. Plus, AI is actually augmenting data pros, not just replacing them.
That's an interesting point. It suggests a synergy between AI tools and human expertise, which plays well for companies like Innodata using both tech and SMEs.
Emerging trends. Big tech spending massively on AI infra, maybe hardware costs coming down, more focus on data quality and governance, cloud AI integration, demand in specific sectors like healthcare, auto, finance, and maybe more crowdsourcing for annotation.
It's a dynamic landscape, lots of opportunity for companies that can adapt quickly.
So who are they up against? Who are the main competitors?
It's a mixed bag. You've got specialized AI service providers, pure data annotation firms, the big IT consultants building out AI practices, and even the in-house teams of their own clients.
The report names folks like Appen, Cloud Factory, Surge AI, Scale AI, and then the giants like Accenture, IBM, Infosys.
Right. The big consultants offer broader services, while the specialists compete more directly on the data prep side.
The research mentioned low formal barriers to entry. Does that mean it's easy to start competing?
Well, starting a basic annotation service might not cost a fortune, but the practical barriers to winning big, serious clients, those are high. You need scale, consistent quality, top-notch security, client trust, maybe proprietary tech like Golden Gate, domain expertise.
Right. Landing one of the Mag 7, let alone 5, shows you've overcome some serious hurdles already.
Exactly. It's not trivial to compete at that level. So while new players can emerge, becoming a trusted partner for critical AI projects is tough. The market will likely stay pretty fragmented too.
What about regulations? Any big hurdles there?
It's evolving. Global AI rules are still being written. Plus, you have strict data privacy laws like GDPR. Operating internationally adds complexity taxes, labor laws, data sovereignty, IP, specific AI rules that might pop up.
And there's always that background risk of U.S. anti-outsourcing laws, though nothing major yet. And tariffs. We'll get to those later.
Right. So lots of practical challenges, even if starting up seems easy on paper. Let's talk competitive advantages then. Their moat, so to speak.
Okay. What makes them hard to beat? Brand strength.
Well, their long history helps. Founded in '88 gives them legacy. And those Mag 7 client wins are huge validation. They get called a leading data engineering company. But their overall brand name might not be as big as, say, Accenture's.
How about cost advantages, economies of scale?
Potentially. That global delivery model in places like India and the Philippines likely helps keep costs down. And their scale, 6,600 plus people, lets them handle big projects. Plus, Golden Gate could boost efficiency.
Network effects. Probably not much for the core services, right? Maybe a weak one for the agility PR platform.
Agreed. Not a major factor. What about switching costs for clients?
Could be moderate to high, I'd think. Especially for clients using their integrated platforms like Synodex, Agility, or Golden Gate. Moving data, retraining people, changing workflows. That's a hassle.
Less sticky for pure project work in DDS, maybe? Though finding a new vendor and ensuring quality still has costs.
Yeah, seems like their strategy is probably to get more integrated, raise those switching costs.
Mm.
What about unique assets, things only they have?
Their proprietary tech stands out. Golden Gate, that new Gen AI test platform. Their skilled global workforce, including those SMEs, decades of experience, especially in certain sectors like publishing, healthcare, PR, and they handle diverse data types.
So, summing up the moat for you, the listener, it's not like a fortress, maybe more like difficult terrain for competitors. Hard to replicate their scale, tech, and top client trust all at once, but
they need to keep innovating, right?
Yeah.
Tech changes fast. That advantage needs constant reinforcement.
definitely. Okay, let's pivot to the people running the show. Chapter 2, management evaluation.
Right, leadership is critical. Who's in charge?
CEO is Jack Abuhoff, co-founder CEO since 1997. That's incredibly long tenure.
Since 1997. Wow. He knows the company inside out. Been on the board since day one, too. Even did stints as chairman and interim CFO. Background in IT outsourcing, international ventures, finance, Columbia, Harvard Law.
Yeah, deep roots. Performance under him has varied historically, but the recent pivot to AI services, that led to that accelerated growth, 20% in 2021, then the huge 96% jump in FY 2024 with the big tech clients.
So he oversaw that strategic shift successfully. What about their targets?
Back in early 2022, they aimed for about $200 revenue and a 30% EBITDA margin by 2025. In FY 2024, they had $170.57 revenue and 20.3% adjusted EBITDA margin.
So revenue target looks reachable, but that 30% margin might be tougher. Still, progress on growth is clear.
Yep. Other key execs include the general counsel, SVP of engineering leading AVL platform development, seems like relevant experience there, COO, and an interim CFO.
Having strong technical leadership, especially in AML platform dev, is definitely a plus. Shows they're investing in the core tech.
How have they handled crises? Info was a bit limited. They adapted to COVID with remote work. Risk factors mention potential hits from health crises, geopolitics.
Standard stuff, mostly. Without transparency, communication with investors.
Seems pretty standard public company practice. Quarterly reports, earnings calls with Q&A, SEC filings, investor website, press releases. CEO does interviews. They give revenue guidance predicting 40% plus growth for 2025.
Okay, so they're communicating the basics. What about ethics? Any red flags?
No major scandals found, but those ISS corporate governance scores from April 1st, 2025, they're not great. Overall, 6 out of 10, audit 5, board 7, shareholder rights only 5, and compensation gets an 8 high concern level.
Oof. An 8 on compensation and a 5 on shareholder rights. That's concerning. Often signals potential misalignment between exec pay and shareholder interests.
Definitely raises an eyebrow.
Yeah.
And there was this unverified blog mention of an insider trading investigation, need to stress, unverified, treat with extreme caution.
Absolutely. Stick to the verified stuff. But those ISS scores, especially on comp and rights, are real points of concern for investors.
So the management picture, it's nuanced. Successful pivot, driving growth. But serious questions about shareholder alignment from those governance scores, especially compensation. Critical point for a value-focused listener.
Agreed. Now, how are they using their money? Capital allocation.
Seems focused on organic growth, reinvesting heavily in the core business. They said they plan to reinvest cash flow in 2025 for multi-year growth. Budgets up for sales, marketing, new products like Golden Gate, the Gen AI test platform, tech upgrades, infrastructure too. CapEx projected around 11 HEMS for 2025, up from $6.02 in FY24.
Reinvesting for organic growth makes sense if the returns are good, are they?
We'll get to ROIC in a sec. M&A. They might do deals, but it's not the main focus now. They bought Mediumizer in the past for agility, but now it's mostly internal growth.
Okay, share buybacks, dividend.
Nope. No mention of buybacks,
Right.
no dividends paid historically, none expected. All earnings plowed back into growth.
So stock price appreciation is the only way shareholders see a return. Puts a lot of pressure on delivering growth and getting the market to value it.
Exactly. Now, return on invested capital, ROIC. The recent numbers are incredibly high. Morningstar reported normalized ROIC over 73%. Google Finance had ROC near 47%, maybe Q4 annualized.
Wow, 73%, 47%. Those are huge numbers.
Wow. Yeah, ROE also showing big increases. Morningstar had ROE over 82%, ROA over 40%, likely boosted massively by that rapid revenue scaling.
Very impressive returns, suggesting recent investments are paying off handsomely. But the question is sustainability.
Right, so capital allocation takeaway for you, the listener. Strategy is clear, reinvest for growth. The recent returns look fantastic, but no direct returns via dividends or buybacks. And this ties back to that insider selling. Seems contradictory, right? High ROIC, yet insiders are selling heavily.
That is a notable contrast. If the returns are so great, why are insiders selling so much? Maybe they think the current price already reflects that future potential. It definitely makes you think.
Okay, let's nail down the numbers. Chapter 3, Financial Health.
Yeah, time to look under the hood at the key metrics and stability.
Market cap, as we said, around $1.2 billion as of today, April 29th, 2025. Price to earnings ratio, PE, trailing 12 months, about 44.9. Forward PE, also mid-40s.
A PE in the mid-40s is pretty rich. Signals high growth expectations baked into the price.
Definitely. Revenue growth, we covered the explosive 96% in FY 2024 to $170.05. Q4 24 was 127% YoY growth, mainly DDS, mainly that one big client. Management guiding for 40% plus in FY 2025, big change from the moderate growth before 2021.
That acceleration is key, but sustainability and diversification are the watchwords.
Profit margins also saw a huge leap in FY 2024. Gross margin up to 39% from 36%. Operating margin jumped from basically 0 to over 14%. Net margin went from negative to almost 17%.
Significant margin expansion alongside that revenue growth, that's powerful. Shows operating leverage, maybe better pricing. TTM margins look similar, around 14% operating, 17% net. Q4 net margin even higher at 17.4%.
Debt to equity at year-end 24 was about 0.79. So moderate leverage seems manageable, low debt compared to EBITDA, strong solvency.
Good, and free cash flow.
Generating positive FCF, estimated around $28.08 for FY 2024. Q4 alone was over $11.
Price to book ratio, PB, very high, somewhere between 17 and 19 based on year-end 24 figures. Wow, 17 to 19 PB. That implies huge value placed on intangibles, tech, relationships, brand, not just physical assets.
So the key takeaway on metrics for you. Innodata is profitable now, strong balance sheet, but the valuation multiples, PE, BB, are extremely high. The market expects continued stellar growth. Big departure from traditional value metrics, big risk if they don't deliver.
Absolutely. High expectations mean high risk if they stumble. Now, what about stability, consistency over time?
Yeah, that's where it gets tricky. Earnings history looks volatile. That strong FY 2024 profit followed an FY 2023 loss. There were losses in earlier years too, like Q1 2016. Mention of that re-architecting in 2021 makes you wonder if the recent surge is sustainable or a temporary effect. Long-term predictability, questionable.
That historical volatility is a really important piece of context. Makes forecasting future earnings much harder.
Dividends, as we said, not applicable. Debt management looks prudent. Moderate DE ratio, access to an undrawn $30 credit line for liquidity. Positive operating income means they can cover debt payments.
Sensible debt management and that credit facility add a layer of safety, which is good given the earnings volatility.
Working capital looks well managed too. It jumped in 2024, mostly because their cash balance grew a lot, almost 47 EVers at year-end 24 versus $9 the year before. Current ratio and quick ratio are healthy, around 2.05 and 1.90. Plenty of liquid assets for short-term needs.
Strong liquidity is always good to see.
So putting it all together on financial stability for you, the listener, earnings have been historically volatile, making this recent profit surge potentially fragile, especially with that client concentration. But they don't have excessive debt, and the balance sheet looks strong right now, giving them a buffer. It's this contrast, volatile earnings history versus current balance sheet strength, that's key to grasp.
It really highlights the trade-offs. Strong foundation from the balance sheet, but uncertainty around future performance due to past volatility and current risks.
Okay, that wraps up the first half of our deep dive on Innodata. We've covered business, management, and financials. Coming up after a quick break. Market sentiment, ownership, risks, including those 2025 U.S. tariffs, and our final thoughts.
We've laid down the essential context. Now we get into the more dynamic factors influencing the stock.
Exactly. And hey, if you're finding this breakdown useful, make sure you subscribe to the Stock Analytics AI YouTube channel. We do these deep dives regularly to help you understand complex companies and market trends. Don't miss out.
And just that quick reminder, this analysis is based on info available as of April 29th, 2025. It's our interpretation. AI is moving incredibly fast. Always, always do your own research before making any investment decisions. You can find the sources we use listed in the description.
All right, we'll be back shortly to tackle market sentiment and more on Innodata.
Welcome back to our deep dive on Innodata. We've covered the business, management, and financials. Now let's get into Chapter 4, market sentiment. How is the market actually perceiving this stock?
Well, it's generally seen as a significant AI player.
Yeah.
You can tell just from that massive stock price run-up, year-over-year gains were over 450%, even hit 569% at one point.
Huge appreciation, but also highly volatile, right?
Extremely. Beta figures range from 2.7 up to maybe 4.3, average true range around 10%. Recent momentum labeled very strong. So the bullish sentiment is clearly driven by the growth story, the margin expansion, those big tech client wins, and their position in the AI market.
But there must be a bearish case, too, given the volatility.
Oh, yeah. Concerns focus on, can they sustain this growth? That client concentration risk we keep mentioning.
Oh.
The very high valuation, intense competition.
And there was a recent dip in price, despite seemingly positive news, so real tug-of-war.
What's the recent news flow been like?
Mostly positive, actually. New program awards, launching that Gen AI test platform, strong earnings beats, positive analyst updates. One day saw a 12% jump.
Okay, so positive news overall. What are the analysts saying? Price targets. Analysts are definitely bullish. Consensus seems to be strong buy from the 4 or 5 analysts covering it. Recommendations are pretty much 100% strong buy or buy.
And the price targets themselves, what kind of upside are they seeing?
The average targets range from about $66 up to maybe $75.48. That implies significant upside from the current price, around 38 cents. High targets go up towards $79, lows are wide-ranging from $40 up to maybe $72.
So analysts are optimistic, projecting considerable gains. Have there been recent updates?
Yeah, target increases, new initiations mentioned. The Q4 2024 earnings beat back in February was big news, plus a strong guidance for 2025. Launching the Gen AI platform in March was seen positively too, and they announced new program awards from a Mag 7 client worth about $20 annually.
What's next? Key events to watch.
Q1 2025 earnings are coming up soon, May 8th. That'll be crucial. Analysts are expecting around $57.06 revenue and $0.20 EPS. We'll see if yes, significantly. Short interest is high. Around 5 million shares short as of mid-April, slightly down from late March. That's roughly 17–18% of the float, depending on the source one, had it lower at 12.4%.
17–18% short interest is quite high. Suggests a strong contingent believes the stock is overvalued or faces significant risks.
Days to cover are somewhere between 2.6 and 4.8 days, and a high percentage of that short volume is happening off exchange, in dark pools.
Interesting. What about options activity?
The put-call open interest ratio is 0.31, meaning significantly more open call options, bets the price will rise, than put options, bets it will fall. But the implied volatility is extremely high, over 120%.
High 4 reflects the market expecting big price swings, consistent with the stock's history and the high short interest.
So the market sentiment takeaway for you. It's extremely polarized. Analysts are very bullish, predicting big upside. Yet a large number of traders are betting heavily against the stock via short selling. High volatility is the name of the game. Upcoming earnings are critical.
That divergence between bullish analysts and high short interest is fascinating, really highlights the data around the company's future. Okay, let's move to Chapter 5, ownership structure. Who actually owns Innodata?
Institutional ownership is pretty significant, estimated somewhere between 45% and 54% of the shares.
So institutions have a substantial stake. Who are the top holders?
BlackRock is the largest, holding around 6.5–6.9%. Vanguard is next with 5.2–5.4%. Lusick Partners also holds a significant stake, around 5.0–5.5%.
Any other notable names?
Yeah, firms like D.E. Shaw, Janus Henderson, Geode, State Street, Renaissance Technologies, Dry House, Next Century hold stakes in the 1–3% range.
What's the recent trend? Are institutions buying or selling?
Recent activity, particularly in Q4 2024, seemed to suggest net buying by institutions. D.E. Shaw, Dry House, J.P. Morgan were noted buyers. Only one notable seller mentioned.
Okay, so institutions seem to be increasing their positions overall. What about insiders, management directors?
Insider ownership figures vary, depending on how you define it, ranging from maybe 4.4% up to 26.3%. CEO Abuhoff holds around 3.84%. But the really striking thing is the transactions.
Oh, what's happening there?
Overwhelmingly heavy insider selling over the last 6 to 12 months. Massive amounts. CEO Abuhoff estimated around $38 million worth. COO Mishra, maybe $25 million. Director Tor, $36 million. Director Massey, $5 million. Interim CFO Espinelli, $3.8 million. Director Forlenza, $2.2 million.
Wow, those are huge numbers, selling across the board by top execs and directors.
Yeah, numerous open market sales in late 2024 and early 2025, often linked to exercising stock options, but still significant selling pressure. And critically, no open market purchases by insiders reported in the last 3 to 12 months, net selling over 2.1 million shares in the last year.
That is a very stark contrast. Institutions appear to be net buyers, while insiders are selling heavily. That's a major divergence.
It really is. How concentrated is the ownership overall?
It seems relatively diffuse. BlackRock, the largest holder, has less than 7%. Top 25 holders have less than 50% combined. The public and retail investors hold the largest block, maybe 50–58%. No single controlling entity.
How might this ownership structure and the insider selling relate back to those corporate governance concerns we discussed?
Well, those ISS scores showing weaknesses, especially in compensation, that high concern 810 score, and shareholder rights, 510, it fits a pattern. The board includes CEO Abuhoff and a long-tenured independent director who chairs the audit committee. But this pattern of heavy insider selling, potentially linked to their compensation structures via option exercises, definitely raises governance questions about alignment with long-term minority shareholders.
So the key takeaway on ownership for you, the listener, institutions seem to be buying the growth story, adding to their positions. But insiders, they're selling, and selling a lot. This divergence is critical. And those governance concerns around compensation might help explain why insiders are selling so much. Something serious to consider.
Absolutely. That insider selling is a major flag, especially contrasted with institutional buying. Okay, let's shift to Chapter 6, Risk Assessment. What are the key risks Innodata faces? Maybe start with a SWOT analysis summary.
Okay, Table 6 in the report breaks it down. Strengths. Their AI data expertise, long experience, proprietary tech like Golden Gate, that recent strong growth, the big tech client wins, global scale, strong balance sheet now, high ROI, ROE.
Solid list of strengths. Weaknesses.
High client concentration is top of the list. Historically volatile earnings, questions about sustainability, those poor governance scores, and heavy insider selling. Reliance on key personnel.
Opportunities.
Huge AI market growth, obviously. Chance to expand relationships with current clients, win new ones, move up the value chain with things like the GenAI test platform, maybe use crowdsourcing more, expand geographically or into new industries. Strategic M&A is always a possibility, too.
And the threats.
Dense competition. Rapid technological change, always a risk in tech. A slowdown in client spending, especially from those big tech clients. Losing a major client would be catastrophic. Data privacy and security breaches, geopolitical instability, currency fluctuations, changes in tax laws, that background risk of U.S. anti-outsourcing sentiment, industry-wide data quality issues, and U.S. tariffs.
Okay, let's specifically drill down on those 2025 U.S. tariffs mentioned in the report. How might they impact Innodata? First, what are these tariffs?
Right, the report describes tariffs enacted in early 2025. A baseline 10% on many imports, but much higher rates on specific countries like China, potentially combined rates hitting 125–145%. Also tariffs on goods from Canada, Mexico, and specific sectors with limited exemptions.
What are the projected economic impacts?
Generally negative. Higher consumer prices, reduced imports, potentially lower GDP growth, maybe some job losses, though offset partly by tariff revenue. Retaliatory tariffs from other countries are also a factor, though there was apparently a 90-day pause on escalating those reciprocal tariffs in April 2025, except for China.
So how does this directly impact Innodata? They're primarily a service provider.
Exactly. The direct impact is likely minimal. They don't import vast quantities of physical goods. Maybe a slight increase in costs for IT hardware if it comes from affected countries, and probably not significant. Their exported services generally aren't subject to these goods tariffs.
Okay, so direct hit is small. What about indirect impacts?
This is where the major risk lies. It's primarily through the negative effects on Innodata's clients and the broader economy.
How so? Impact on clients.
This seems the most significant risk. Many of their key U.S. tech clients rely heavily on global supply chains and international sales. Tariffs could increase their operating costs, squeeze their profits.
Which could lead them to cut back on discretionary spending. Things like AI and data engineering projects, Innodata's bread and butter.
Precisely. Or just disrupt the initiatives Innodata is supporting. The report used examples like Tesla and Boeing to illustrate how large tech-related companies can be vulnerable to tariffs, even if Innodata isn't directly hit.
So client business impact is the big channel. What else?
A general economic slowdown. The tariffs are projected to slow U.S. and global growth. That could dampen demand for IT and AI services across Innodata's entire client base, not just the big tech ones.
Could there be any potential upside? Supply chain shifts?
Possibly. Clients might restructure supply chains away from heavily tariffed regions. That could disrupt existing projects Innodata is working on, or potentially create new opportunities for Innodata to help with those transitions. It's uncertain.
And just the general uncertainty factor.
Right. Tariffs add to global economic and regulatory uncertainty. That can impact long-term investment decisions and maybe influence regulations relevant to Innodata, like cross-border data flows or AI governance.
Any specific tariffs particularly relevant?
The high tariffs on China are relevant mainly because of the potential impact on U.S. tech clients who have significant exposure to China, either in their supply chains or sales. The limited exemptions for electronics probably won't offset the broader impact on those clients.
So the conclusion on tariff impact for Innodata?
It's a potentially significant indirect risk, primarily to the negative consequences for their concentrated base of large tech clients, possibly leading those clients to cut spending. Direct operational impacts look minor. But the tariffs really amplify that existing client concentration risk and underscore the geopolitical risks of their global operations.
Okay, so the key takeaway on tariffs for you, the listener. Innodata itself likely isn't directly harmed much, but its major clients could be significantly affected. And if they pull back spending on AI data projects, Innodata feels the pain. It's a crucial indirect risk tied directly to that concentration issue.
A very important nuance to understand. Okay, let's move towards wrapping this up. Chapter 7, conclusion and that final thought.
Yeah, for reflecting on everything we've covered, it's clear there are some major contradictory signals surrounding Innodata.
Definitely. On one hand, you have that incredibly strong recent growth and margin expansion.
But it's driven heavily by that one massive client, creating huge concentration risk.
You have analysts who are overwhelmingly bullish, setting high-priced targets. But you also have very high short interest, meaning many are betting against the stock.
Institutions seem to be net buyers, accumulating shares.
While insiders are selling heavily, raising questions about alignment and their view of the valuation.
The recent financial performance looks strong. Profitability, high ROIC, solid balance sheet.
But the earnings history is volatile, the valuation multiples are sky high, and the stock price itself is incredibly volatile.
So while Innodata is undoubtedly operating in a very exciting and high-growth space, AI data engineering, several factors raise significant concerns, especially for a value-conscious investor looking at the situation as of today, April 29th, 2025.
Absolutely. Which leads us to a final thought, maybe a provocative question for you, the listener, to mull over after this deep dive.
Let's hear it.
Given everything we know, the rapid AI advancements, data's critical role is Innodata, a kind of leading indicator. Does it represent a fundamental shift in how businesses create value in this new era? Or is its current success mostly just reflecting the massive amounts of capital being thrown at AI by a handful of tech giants right now, a spending spree that might not last forever or might shift focus?
That's a great question. Is it sustainable, broad-based value creation or riding a temporary wave of concentrated spending?
Exactly. It encourages you to think deeper, maybe research the long-term trends in AI infrastructure spending. Keep a close eye on whether Innodata successfully diversifies its client base away from that heavy concentration. Those are key things to watch.
A very insightful question to leave our listeners with.
And again, if you appreciated this level of analysis, please subscribe to the Stock Analytics AI YouTube channel for more deep dives.
And remember, this analysis is based on information up to April 29th, 2025, and involves interpretation. The AI field changes daily. Do your own homework. All sources are in the description.
Okay, thank you for joining us on this deep dive into Innodata.
We hope breaking down these complex factors helps you think critically and make more informed decisions.
Definitely. Understanding the nuances, the good, the bad, the contradictory is key. Maybe think about questions like, how exactly is Innodata trying to diversify clients? What are the long-term plans for Golden Gate? How do they see the competition evolving? What should you watch for in their next earnings report?
Lots to keep tracking. Thanks for listening.
We'll catch you on the next deep dive.